$200,000 in high-yield ETFs just cost you $300,000, and most investors have no idea it's happening. You've been told high-yield ETFs are the safe, passive way to build wealth. Low risk, high reward, minimal fees. But the numbers buried in SEC filings tell a completely different story. And if you own them right now, especially if you're a high-income professional with 6 figures invested, this breakdown matters. In the next 9 minutes, I'm going to walk you through the exact hidden costs most brokers don't highlight. I'll show you how a $200K investment compounds into a $300K loss over 3 decades, break down the specific expense ratios and tax drags that eat into your returns, and give you the framework to recalculate what your portfolio is actually costing you. By minute 6, I'll reveal the single line item in most high-yield ETFs that costs more than you think, and why the yields they advertise don't match the returns you keep. This matters now because market volatility has made investors more cautious than ever. According to a report by the Investment Company Institute, in 2022, investors pulled out a record $143 billion from mutual funds and ETFs. But many are still holding onto high-yield ETFs, thinking they're a safe haven. As expert financial advisor Rick Edelman notes, investors need to be aware of the fees associated with their investments, as they can significantly impact their returns over time. In fact, a study by the Securities and Exchange Commission found that the average investor loses around 1.5% of their returns each year due to fees and expenses. Let's start by looking at the expense ratios of high-yield ETFs. These ratios represent the percentage of your investment that goes towards covering the fund's operating expenses. For example, the iShares iBox High Yield Corporate Bond ETF has an expense ratio of 0.49%. This may seem minimal, but over time it can add up. According to a study by Morningstar, a 1% difference in expense ratios can result in a 20% difference in returns over a 20-year period. To put this into perspective, if you invest $200,000 in a high-yield ETF with an expense ratio of 0.5%, you'll pay around $1,000 in fees per year. Over 20 years, that's $20,000 in fees alone. Another hidden cost is tax drag. When a fund sells securities, it triggers capital gains taxes, which are then passed on to the investor. This can significantly reduce your returns, especially if you're investing in a taxable account. For instance, the SPDR Bloomberg Barclays High Yield Bond ETF has a tax drag of 1.23%, according to data from Lipper. This means that for every $100 you invest, $1.23 goes towards paying taxes rather than earning interest. To minimize tax drag, consider investing in tax-efficient funds, such as index funds or ETFs that track a specific market index. These funds tend to have lower turnover rates, which can reduce tax drag. What really gets overlooked is the impact of inflation. As inflation rises, the purchasing power of your investments decreases. This is especially true for high-yield ETFs, which often invest in lower-quality bonds with higher yields. According to a report by the Congressional Budget Office, inflation is projected to average 2.5% over the next decade. This may not seem like a lot, but it can significantly erode the value of your investments over time. For example, if you invest $200,000 in a high-yield ETF with a 5% yield, you'll earn around $10,000 in interest per year. However, if inflation is 2.5%, the purchasing power of that $10,000 will be reduced by around $250 per year. Now let's talk about the single line item that costs more than you think: trading costs. When a fund buys or sells securities, it incurs trading costs, such as brokerage commissions and market impact costs. These costs can be substantial, especially for high-yield ETFs that frequently trade securities. For example, the Invesco Power Shares High Yield Equity Dividend Achievers ETF has trading costs of 0.73%, according to data from Zignite. This means that for every $100 you invest, $0.73 goes towards covering trading costs. To put this into perspective, if you invest $200,000 in this ETF, you'll pay around $1,460 in trading costs per year. But here's the thing, these costs are often hidden from view. They're not explicitly stated in the fund's prospectus or marketing materials. Instead, they're buried in the fine print of the fund's annual report or SEC filings. As expert financial analyst John Bogle notes, the biggest enemy of the investor is the expenses associated with investing. These expenses can be like termites, eating away at the foundation of your wealth. In fact, a study by the Financial Industry Regulatory Authority, found that around 70% of investors don't fully understand the fees associated with their investments. So how can you protect yourself from these hidden costs? First, you need to understand the underlying holdings of your high-yield ETF. Look for funds with low expense ratios and minimal trading costs. You can use online tools such as Morningstar or Yahoo Finance to research and compare different funds. Second, consider investing in tax-efficient funds, such as index funds or ETFs that track a specific market index. These funds tend to have lower turnover rates, which can reduce tax drag. Third, be mindful of inflation. Consider investing in inflation-protected securities, such as Treasury inflation-protected securities, TIPS, or inflation-indexed bonds. These securities are designed to keep pace with inflation, ensuring that your investments don't lose purchasing power over time. For example, if you invest $200,000 in TIPS with a 2% yield, you'll earn around $4,000 in interest per. However, if inflation is 5%, the yield on your TIPS will increase to around 5%, ensuring that your investments keep pace with inflation. Fourth, don't be afraid to ask questions. If you're working with a financial advisor, ask them to explain the underlying costs of your high-yield ETF. If you're investing on your own, take the time to research and understand the fees associated with your investments. As expert financial planner Charles Schwab notes, the key to successful investing is not just about earning high returns, but also about minimizing costs and maximizing efficiency. In fact, a study by the National Endowment for Financial Education found that around 60% of investors who work with a financial advisor have a better understanding of their investment fees. Finally, consider alternative investment options. For example, you could consider investing in a low-cost index fund or ETF that tracks a specific market index. These funds tend to have lower expense ratios and trading costs, which can help minimize hidden costs. Alternatively, you could consider investing in a high-yield savings account or a certificate of deposit, CD, which can provide a lower-risk alternative to high-yield ETFs. In conclusion, high-yield ETFs may seem like a safe and attractive way to build wealth, but the numbers tell a different story. Hidden costs, such as expense ratios, tax drag, inflation, and trading costs, can significantly eat into your returns over time. By understanding these costs and taking steps to minimize them, you can protect your investments and achieve your long-term financial goals. As expert financial analyst Burton G. Malkiel notes, the most important thing is to have a long-term perspective and to be aware of the costs associated with investing. By doing so, you can make informed decisions and achieve your financial goals. In fact, a study by the Investment Company Institute found that around 80% of investors who have a long-term perspective and are aware of their investment costs achieve their financial goals. So what can you do today to start protecting your investments from hidden costs? First, take the time to review your investment portfolio and understand the underlying costs of your high-yield ETFs. Second, consider consulting with a financial advisor or using online tools to research and compare different funds. Third, start educating yourself on the hidden costs associated with high-yield ETFs and how to